Okay, so I think we should start. We have exceeded the magical threshold of 100 participants, which is good. Good afternoon, everyone. A very warm welcome to eSight and to today's webinar, which is about the economic and wider socio-economic implications of the OECD's proposed corporate tax reform. I will wear two hats today. My first hat is that I will be the moderator of today's webinar, and my second hat is that I will also give a brief presentation in a minute about the major findings of a study that I recently published on the economic implications of the OECD's Pillar 1 and mainly Pillar 2 corporate tax reform proposals. We will have three guest speakers with us today, all of them distinguished experts in the area of corporate taxation. And these are, in alphabetical order, Krista Anderson from Brussels-based Business Europe, Daniel Bunn from the Washington, DC-based US Tax Foundation, and Sigurd Næss-Schmidt from the consultancy company Copenhagen Economics. Our discussions are guided by a few questions, and these questions are as follows. We want to address who it is who will actually gain most or lose most from the OECD's Pillar 1 and 2 proposals. Is it small countries? Is it large countries? Who is it who will pay the bills of the proposal? What will be the implications for global trade and investment policy making? What will be the impacts on investments and governments' ambitions to upgrade national economies? And finally, why are governments actually resisting simpler and, let's say, more fair, or at least rules of corporate taxation that are perceived with a higher degree of fairness and transparency? Why are governments resisting such rules in corporate taxation? We will proceed as follows. I will have a 15-20 minute presentation of the study that I just mentioned. Then we will have about 10 minutes interventions and assessments from each of our guest speakers, which they can share their perspectives and the economic assessments of the OECD's Pillar 1 and 2 proposals from a broad range of perspective. Before I start, however, I would like to ask our three speakers to briefly introduce themselves and give us a sense of the kind of work they are doing with respect to corporate taxation. And let's start with you, Krista.
Thank you, Matthias, and thank you for inviting me to comment on this very interesting study, which we will discuss here today. I'm the chairman of the tax policy group of Business Europe, and at Business Europe we deal with all kinds of tax issues, but to a very large extent, of course, corporate tax matters, and we do not only look at EU related matters, but also worldwide and OECD topics. I'm also the vice chair for business at OECD, BIAC, in tax policy. And of course, there we have also engaged with the OECD in these discussions. I spend part of my time on taxation in Brussels also with the European Economic and Social Committee, where I'm the vice president of the employers group. So that's the background from my side. Thank you.
Thanks, Krista. Yeah, everybody could hear you well, I guess. You are wearing many hats as well. You bring a lot of expertise to this panel, I'm sure. Daniel, how about yourself?
Thanks, Matthias, and I'll echo Krista in just thanking you and eSight for having me today. My name is Daniel Bunn. I'm Vice President of Global Projects at the Tax Foundation. As Matthias said, we're based in Washington, DC. My project focuses on comparing the tax policies of countries around the world and exploring the impacts of multilateral proposals for tax policy. So Tax Foundation has what we call the International Tax Competitiveness Index, which compares the OECD countries on their tax policies. But we also are very interested in global growth, global investment. And this is where this event and the Pillar 1 and Pillar 2 discussion fits into my work.
Great. Thanks for this this kind introduction. I think people are now also aware, people who followed our previous events when we had you to discuss how global taxation is evolving, how countries are shaping their corporate tax regimes, but also other types of taxation. The tax competitiveness report is a very important contribution to the debate. I understand it appears every year with updated tax data, data on tax regimes, tax rates, respectively. And I can only recommend people to go to the website of the US Tax Foundation, download the report and the numbers attached to it. It's a very rich source of data and information. Well, and now we finally have Sigurd Nash-Smith. Sigurd, could you introduce yourself, please?
Yes. Hello. Yes, my name is Sigurd Nash-Smith. I'm a partner with economics consultancy that is focusing very much on regulatory economics in areas of high business interest. I'm leading our finance and tax service. In that capacity, I worked on international tax issues for a number of years, not the least for the European Commission, the tax route for a number of years, looking at different issues of taxation, including financial transaction taxes on the banking sector. And that's also an area that we have worked a lot on in the preceding years. Most recently, I worked on for different private clients, mainly around the DST proposal by the Commission, and also did some work on the what has now become the consumer-facing tax proposal put forward by the OECD that was originally very much a US proposal. So I'm looking very much forward to the debate today, your presentation, and the discussion that will follow. Thank you very much.
Yeah, thanks, Sigurd, for your introduction. Again, I can recommend different studies and articles that were published by Copenhagen Economics, not only on corporate taxation, but also on the impact of other types of taxes. You just mentioned the digital services tax, which is a kind of a hybrid between the corporate tax and the tariff, but also the financial transaction tax and the industry intelligence your company offers, and linking that to basic economics, basically, is always worth a read when you're interested in solid impact analysis, which unfortunately is something that we do not see too often in the debate about corporate tax, particularly when it comes to impact assessments that actually should be done on the side of governments and governmental institutions, including the European Commission, but also the OECD. And that basically leads me to my presentation. As I said, I will take about 15 to 20 minutes of our time to present you the major findings of a study that I recently published. Let me just share my screen with you. I just put it on my screen. Can you see it as well? Yeah.
Yes, we can.
Yeah.
Yes.
Very well. Thanks. Thanks for this confirmation. And yeah, let me dive into it right away. This study was published about 6 weeks ago. It's a study in which I look into what I call the unintended and undesired impacts or consequences from the OECD's Pillar 1 and 2 proposals, with a particular focus on so-called small and open economies. Why did I do this study? Why did we decide to dive into this subject with regard to our research? So first of all, the insight that corporate tax law is very complex and it varies significantly between different jurisdictions. At the same time, over the past 4 decades, at least, we've seen governments globally competing for investment and business activities through lowering their statutory and also their effective corporate tax rates, which is reflected by literally thousands of special tax incentives and tax exemption policies for businesses to invest, but also to research, for example, and to expand employment in the domestic economy. And we even see some special economic zones who grant full corporate tax exemption because governments, local governments, national governments want to stimulate commercial activity. And that is basically investment, production and employment in certain regions of the national economy. Now, at the same time, we now see a certain narrative popping up that is for a long time being shared by individual governments, by EU institutions like the Commission, the European Parliament, but also the OECD, and that is that corporate tax avoidance, which is actually legal, is supposed to be a problem, or is framed to be a problem. We've seen the Pillar 1 and Pillar 2 proposals from the OECD. I suppose that most people in our audience are aware of it. We can come back to them later. And we see for these proposals, which have been tabled about a year ago, we do not see solid impact assessments so far. And when I say solid impact, I'm referring to comprehensive impact assessments covering many economic aspects, socio-economic aspects, but also the long-term and the short-term implications of the proposals if they were to be implemented. We have what I would call dubious, at least rudimentary assessment by the OECD, with which many governments are unhappy. And at the same time, individual governments also fail to conduct impact assessments on their own, or they are hesitant to make their assessments available to the general public. In the OECD's assessment of Pillar 1 and Pillar 2, it is concluded that the implementation of the current proposals would raise additional tax revenues of about $100 billion. To combine effects would be broadly similar across different country groups, that is high, middle and low income economies, amounting to some 4% of current corporate tax revenues. At the same time, the analysis of the impact on effective corporate tax rates does not take into account potential behavioral responses of governments. And it is argued that if the proposed reforms would be implemented, then investment would be driven by other factors than taxation, for example, infrastructure, education, labor cost, which is certainly right. But these issues have not been looked into anymore in these assessments. So the OECD is, let's say, in a way disregarding or neglecting the impacts resulting from local economic and also political institutions on investment. The overarching objective of the OECD is to combat corporate tax avoidance. Often we read terms like aggressive tax planning or abusive tax practices, referring to what tax officials call base erosion, corporate tax base erosion, which is considered a problem by many countries these days, by many governments these days. But in the assessment and also our assessments, little to no attention has been paid on the impacts on overall economic activity, how companies, basically multinational enterprises, actually respond to changes in effective corporate tax rates and effective corporate tax rate differentials. What would be the implication on regional investment? The OECD is claiming that the global capital allocation would improve, but it is not further substantiating this claim. And we do not know much about the actual budgetary impacts on a country-by-country basis. And as I said, the OECD's assessment and also our assessments are in a way, ignorant to the medium and long-term effects on small and open economies. And then no attention has been paid, and this is what I will come back to in a minute. No attention was paid on the future development of the quality of governmental institutions, including features of state interventionism, corruption, cronyism, but also appetite for non-discriminatory trade and investment policy making. And no attention was paid on future governments' incentives to increase their own attractiveness for entrepreneurs and investors from abroad, but also the quality of institutions like infrastructure, education, professional qualifications, and research and development capacities. And finally, the OECD, but also other observers, and I'm mainly referring to political actors, but also academics, they so far disregarded or ignored complexity considerations and the political economy. And basically that's about the question who is actually to gain from a dramatic increase in complexity that we would see from the implementation of the OECD's current proposals. And then we see academics actually contradicting with the OECD's boldest claims. There is an IMF working paper, for example, from 2019, in which the authors argue that profit shifting is actually good for investment in the global stock of capital. It unambiguously reduces the cost of capital. And against this background, the authors of the IMF paper actually question the efforts at curbing profit shifting. And they also argue, and this is important also for the methodology and the results of my study, they also argue that profit shifting is a component of tax competition and that governments are unlikely to give up on tax competition in the future. Then we saw another larger paper from a group of academics around Michel Desfareux, who argue that tax competition will continue irrespective of an OECD agreement. And the authors highlight that many countries in the past implemented many forms of anti-avoidance rules at the same time as competing on other aspects of their tax systems. And then there is another shorter piece that was published by an institute attached to the University of Mannheim. And the authors of this paper argue that the OECD's reforms could actually increase tax competition and against the challenge of complexity. The authors also argue that the OECD should rather focus on indirect taxes to generate tax revenues at the location of user participation, referring to pillar 1, of course. And they also argue that the value-added tax is an already existing suitable tool to tax consumption in market economies. And beyond academics, there are also some challenges in the political domain. Actually, we hear that the inclusive framework is not as inclusive as its name suggests. The OECD's debate and the proceedings are to a large extent shaped by governments of very large countries like the US, India, and obviously China. And there's only little or no discussion about the impact on small and open economies. And in my paper, I treat small and open economies from a, let's say, a pragmatic point of view, leaving aside various economic definitions for small and open economies related to trade, but also exchange rate regimes and so on and so forth. I simply look at them from the perspective of size, basically the relative size of population and economic activity, and also the degree of openness with regard to governments embracing international trade and investment, but also embracing the free exchange of ideas and ensuring a high quality of governmental institutions with regard to the the state of the rule of law, for example. In my study, I look into the countries of the OECD's inclusive framework, primarily the inclusive framework countries with the highest export intensities on the one hand, and the inclusive framework countries with the lowest export intensities on the other hand. And when you look at these countries, and on this slide, I'm plotting the 30 inclusive framework countries with the highest export intensities against the ones with the lowest export intensities, you realize that those countries which rely or are most dependent on trade are small or very small and open economies. And by comparison, the countries with the least, with the lowest export intensities, which are much less dependent and relying on export, but also imports. The picture for imports is pretty much similar. These countries are, to the largest extent, very large countries, including Turkey, Russia, Japan, the United States, Argentina, Brazil, Pakistan, Egypt, and a few others. And when you compare these two groups of countries, you realize that small or very small, including very small open economies, apply much lower statutory corporate tax rates. Here I'm comparing the mean values on the left-hand side of this chart. And they also manage to decrease their statutory corporate tax rate at a higher pace compared to the largest and least trade-intensive economies. And this is shown on the right-hand side of this chart. At the same time, again, comparing the 30 most export-intensive and, to the largest extent, small and very small open economies to the largest countries, which turn out to be much less import and export intensive, then you realize that small and open economies show a substantially higher degree of economic freedom. They are much less restrictive to international trade and development and investment, and they show a much better recognition or acceptance of the rule of law. For example, the enforcement of contracts. And this is an interesting pattern. So lower taxes for businesses in general, and much better institutions with regard to trade and investment, but also with regard to the quality of governmental institutions, including corruption. So if you would plot corruption here, you would arrive at a similar pattern. When you zoom in, here I did this for 6 countries: Lithuania, Switzerland, and Hong Kong on the left-hand side, representing small and open economies, and China, India, and Argentina on the right-hand side, representing rather large countries with pretty high statutory corporate tax rates. And you realize that Lithuania, Switzerland, and Hong Kong perform much better than China, India, and Argentina, and many others in the list of the least export-intensive large countries with regard to economic freedom, regulatory trade barriers, foreign ownership restriction, basically the restrictiveness to investment, and the state of the legal system and property rights, which is one characteristic of the state of the rule of law in these countries. All of these considerations have been ignored in the OECD's impact assessment, but also in our impact assessments that have been published so far. Speaking of the OECD's assessment, the OECD so far did not account for governments' responses to the shift in taxing rights under Pillar 1, but also limitations on tax competition imposed by Pillar 2. And the OECD does not take into account future changes in individual governments' tax policy-making behavior, basically the future path of tax competition, and also how internationally operating companies will react to new developments in tax competition. When we look into history, but also when we look into reports from multinational organizations, academia, there are many observers who argue that tax competition is a salient feature in the world of taxation, and it is very likely to continue There's a report, for example, published by UNCTAD on investment promotion tools applied by developing countries, where it is argued that tax and other fiscal incentives, for example, subsidies, are still important investment promotion tools. In 2008, in an important publication that arrived from the OECD, it is argued that virtually all governments are keen to attract FDI, to create new jobs, bring in new technologies, and more generally promote growth and employment, to ensure that they are, in our words, attractive to inbound investment. And there are more recent papers, like the one from CDW, Devereux, but also a presentation by Dominika Langmeier from that was done. Held more recently, these authors and others argue that the OECD's tax reform proposals could increase tax competition, with the proposed minimum threshold level of 12.5% being the lower bound. So there will be tax competition up to 12.5%. And that a global minimum effective tax rate may even accelerate tax competition for countries that already apply relatively low corporate tax rates. And that's mainly, as we saw a minute ago, small and open economies. And the simple logic is basically that companies' investment behavior is influenced by the financial burden that is imposed by corporate taxation. And that, of course, feeds back on fiscal behavior, in other words, tax competition. In the study, I look into I look into 3 scenarios, but there's one scenario that is particularly important, and it's basically scenario 3. All OECD countries reduce their effective corporate tax rate to 12.5%, which would lead to a full elimination of current tax rate differentials. So we would have a full narrowing within the group of OECD countries. So I'm only looking into OECD countries. I'm not looking into other countries. But other countries are obviously important. Think of India and China, which account for very high volumes of inbound and outbound investment. What's the logic behind the analysis of this study? It's basically about the determinants of investment. There are generally non-policy factors and policy factors. Non-policy factors include many gravity forces, such as market size, but also distance between the FDI host country and the country where it's coming from, and factor endowment characteristics. And then you have policy factors, basically regulatory factors, trade investment policy making, domestic product market regulations, labor market arrangements, but also corporate taxes. And I think here the OECD is right. If based on Pillar 2, we would see a narrowing or perhaps a full elimination of the corporate tax rate differentials, other factors would gain in importance. And there's plenty of literature arguing that market size and, in other words, economic gravity and economic clout is the most important determinant of investment. So everything else being equal, large countries will always be more attractive than small countries for international investors, because companies find it much easier to access a larger group of customers within a country that is regulated by a certain set of regulations, compared to small countries where regulations differ and where exports to other markets are also more difficult to achieve. Generally, corporate taxes impact on inward and outward investment. My methodology is replicating the methodology that was applied by a paper written by economists from the OECD's economics department. It's not an official OECD paper. It hasn't been discussed much in the past, I would say. when you quote it, you can't quote it as an official OECD publication because it obviously stands in opposition with the political objectives of the OECD and the member states comprising the inclusive framework. And in this paper, it's basically argued that taxation is another important policy factor affecting M&E's reinvestment decisions. And everything else being equal, lower tax countries are expected to have larger inflows and smaller outflows of capital than higher tax countries. And if we look at the status quo, we realize that high tax countries lose tax revenue. And this is the impression of many governments in high tax countries because of the effect of tax rate differentials on domestic FDI positions, while lower tax countries gain in revenue. And the logic behind this assessment is basically that in the absence of bilateral effective tax rate differentials, taxes wouldn't matter much anymore, but other features, mainly market size, economic gravity, would tremendously gain in importance. So in the absence of bilateral effective tax rate differentials, inward FDI of high tax countries would increase and their outward FDI, basically divestment from domestic companies, would decrease, and in a symmetrical way, the inward FDI position of low tax countries, most of them, as we saw, small and open economies, would decrease, and their outward position, FDI position divestment would increase. And I'm applying a certain methodology, basically replicating OECD 2017. You will find it in the paper. And here are the results. The results for the changes in inward investment in percent of total inward assessment, and then here we can see that when we look into inward FDI, inward investment would decrease for most small and open economies, mainly in those countries where we currently see very low, or let's say comparatively low, effective corporate tax rates. I should say statutory and effective corporate tax rates. And in a symmetrical way, outward investment, basically divestment, domestic businesses leaving the country would increase in low tax countries, and it would decrease in countries where we currently see relatively high effective corporate tax rates. I'm coming to an end. The highest positive net impacts on aggregate investment are estimated for the US, France, Germany, and Australia. The highest negative impacts estimated for a bunch of countries, of which many are small open economies, the UK, Canada, Switzerland, Ireland, the Netherlands, Sweden, and Poland. But we should interpret these results with caution. These estimates are indicative by nature. They only point to a certain direction of the effect. This is because the economic mechanisms behind them are multi-phased. Other institutional features, including the legal landscape, the regulatory landscape, they are still important, obviously. And at the same time, we need to interpret these numbers with caution because the FDI data behind this analysis is rather patchy. The OECD's data set is patchy, mainly because of confidentiality, I learned. But as I said, FDI is also sensitive to other non-tax policy factors. All of these factors will continue to play a role when companies need to make a choice with respect to how much and where to invest. These changes in FDI obviously translate into changes in corporate tax revenues. If FDI inward FDI goes down, if countries start to leave the country and and capital is leaving, economic activity is leaving, then this will have an impact on tax revenues from corporate taxes, and mirroring basically the picture that we see for FDI stock changes. We see high tax countries gaining from effective tax rate narrowing, and we see low tax countries losing tax revenues. But this is only the intuitive effect, because FDI-induced increases and decreases also trigger second round effects. The second round effects, they are also depending on the final level of the corporate tax rate that is applied in a certain jurisdictions. In my paper, I am estimating the impacts on the basis of a 12.5% threshold, but as concerns the FDI impacts, the changes basically in FDI positions, they are not depending on the final level of the corporate tax rate. We could also apply 30% as the target rate. What really matters is that the tax rate differentials basically disappear, and this is triggering a reallocation of FDI over a certain period of time. But if you apply a lower percentage rate as a corporate tax rate in your domestic economy, that will obviously impact on your aggregate corporate tax revenues. And here I'm basically looking at the impact of a 12.5% minimum tax rate applied throughout the set of countries, taking into consideration the net impact on FDI. And here you can see that it is the high tax countries that would gain in investment because of mainly market size effects, but at the same time lose corporate tax revenue, which might have to be compensated by other taxes. Just 3 more slides, a few general remarks on the need for corporate taxes or taxes on digital services. On that slide, I'm looking into the actual annual tax revenue per capita in France, Italy, the UK, Austria, and Spain. And we realized that most of the tax revenue per citizen comes from labor income tax and sales taxes. Only a relatively small percentage share is generated from taxes on corporate income. And if you look into the expected revenues from so-called digital services taxes, they are almost negligible compared to what is collected from sales taxes and labor income taxes. And you could add capital income taxes if you want. But the key message basically is that given the complexity that we have with corporate taxation and the relative low impact on aggregate tax revenues, I think this raises the question whether we actually need corporate tax in the first place. Then a final comment on tax complexity. Here I am plotting recent OECD information on the application of corporate income tax rates, France versus Estonia, and we can see that there is a tremendous degree of complexity embedded in France corporate tax regime compared to what we see in Estonia, and this is true for a whole bunch of our countries. And the final slide on the conclusions and what I call the undesired consequences of it's 4 conclusions. The OECD's reforms, mainly Pillar 2, less so Pillar 1, they would have a significant impact on where large multinational companies produce and invest in the future. We would see a shift in taxing power from small open economies to large economies, of which are most very restrictive to trade investment with a poor quality of governmental institutions. And therefore, I argue, contrary to the OECD, that we wouldn't experience and observe an improvement in global capital allocation because the world would likely become much more protectionist, worsening global allocation of capital, which would also have a dangerous signaling effect on low and middle income countries. All in all, the OECD's Pillar 2 reform mainly would come with negative impacts on small countries' investment attractiveness, with adverse effects on their economic ecosystems, to put it that way, overall economic development, including education, but also the capacity to do research and innovation. The reforms will have an impact on economic activity, and obviously the revenues from that are generated from corporate income, and they will feed back on labor income taxes and social security contributions, even though the precise net impacts are close to impossible to be estimated over time. I will conclude with that. I hope it was there. I had to run through the study, and I apologize for this huge amount of information and perhaps some under-reflection of the methodological considerations underlying this piece. But I can recommend you to go through the paper. It's a very intuitive methodology, and I think the results are also pretty easy to digest and intuitive, given the nature of the reforms currently taken into consideration by the OECD and some governments. Thank you. And I would suggest that we start immediately with Chris's comment and Chris's assessment of what we currently see at the OECD and how these proceedings might evolve and what would be the impacts from the point of economics.
Thank you very much, Matthias. I have a few slides, maybe we can put them on. Thank you for a very comprehensive presentation of your report. At the same time, I must say that when you look at the report, you also realize how rigorous it is with all the data collection and analysis performed, which maybe was not really, didn't really follow from your presentation, but you have done a very comprehensive work to gather all this information. On the next slide, I will just show you some of the topics I would like to comment on your presentation and the report. I will say something about the revenue impact, but I will also raise some of the issues you mentioned about implications for government behavior, implications for corporate and investment behavior. Something about tax certainty. You did not speak too much about that, but I think it's a very important topic. And I will make a few conclusions. If we start on the next slide on the revenue impact, of course, organizations like the OECD and the European Commission tend to focus on the revenue, short-term revenue impact. It's rather unfortunate, but at the same time, I do to some extent understand and sympathize with the OECD in all the difficulties they face presenting consensus reports on implications and assessments. But it is, of course, very important that you go further and not only look at the revenue impact. You must also address all the other issues, and I do hope that governments and decision makers take that into account. And you mentioned that UNCTAD, in their annual report, often present this in a very balanced way, that you should be careful as a government introducing some tax adjustments and anti-avoidance measures. You have to have a proportional approach and also take into account the effects on investment in your country and therefore well-being and revenue raised. When it comes to the present impact assessment floating around, we haven't seen too much of it yet. Governments have been issued some calculation sheets and Excel arcs to make their own impact assessment on revenues in particular. We note that it's often a comparison with pre-BEPS measures being included or implemented. And I think this is a major problem when you assess even the revenue impact, because you should do it post-BEPS implementation. So there is there is a bias in also the revenue, short-term revenue estimates. There are, of course, other aspects being very important as something impact assessments should deal with. And one area is, of course, the digital agenda for the future. If you now impose extra taxes in the digitalized economy, and sometimes you even mention specific companies, what will it do for all other companies in their digital agenda, and for governments and citizens embarking, in particular now post the corona outbreak? What will it do for the digital agenda? And we need to use digital tools and developments excessively in the future. And what if you then levy taxes on it, and that kind of activity triggers extra tax payments? Is that really good for your digital agenda? And that is clearly a question that should be posed to the European Commission, which has both an agenda for imposing digital taxes and to have a digital agenda to promote the transition to a greener, sustainable economy, to some extent based on digitalization. I also think revenue implications should look into what can you raise from other types of taxes and sources, in particular VAT or sales taxes. Each government would have basically control of the sales tax and VAT system, maybe not totally in Europe, but if you look at worldwide, countries would control their own tax base to a much larger extent if you apply VAT taxes or sales taxes than if you just have to implement Pillar 1 and Pillar 2. Let's turn to the next slide, and what I think is really important and what is left out, and I think decision makers should be very much aware of, and that's the implication for government behavior and incentives for governments to act one way or another. Of course, small countries have often competed with lower tax rates, and they have done it mainly because they have a small market. Maybe they're in the periphery of a region. Maybe they have very few natural resources, and they maybe have very high transportation costs. So to be competitive at all, they basically only have the tax rate to compete with. It's not a level playing field if everyone has the same tax rate, because all the other factors go against these smaller countries, and they try to compensate and to be competitive by having a more beneficial tax treatment of investments. It's a question of business climate. If you introduce Pillar 1, where you reallocate some of the tax base to countries where the consumption takes place, then you will have a situation where the country where startups, innovations, and production take place may no longer actually tax all the profits of those companies that are profitable. But the country will still often give deductions for losses and startup costs. But the few companies, maybe only 1% of all new companies become really prosperous and show a large profit. To a large extent, the tax on those companies that are profitable will go to other jurisdictions and other countries. Why should then the country for innovation and production allow for all these costs and take all the cost for all these other companies for so many years if they cannot tax the winners at the end of the day? I think this will influence the business climate in a very negative way for countries that have a lot of production and startups. And I think that's something that must be taken into account, that you change the incentive structure for governments. I would also like to mention the cyclicality of public finances. We have situations where in the boom year, of course, governments collect a lot from consumption taxes, labor taxes, and other taxes due to the high economic activity. But typically, we don't base the corporate tax on the consumption, only indirectly, and we tax only the profits of the company. But if you now are to base the corporate tax also on consumption, you get taxed where consumption takes place. You will make also the corporate tax depending on consumption, and therefore in a boom year, you will collect more from the corporate tax than in other years. And that, if you then run into a recession, not only will the country suffer less revenue from consumption taxes like VAT, but they will also collect less from the corporate tax. So you make the public finances even more sensitive to the business cycle. And I think that that's a real concern. A few years ago, Greece had a lot of problems and overconsumption, and they had to undertake very stringent austerity measures to rebalance and recoup a sound public finance situation. Those measures would have had to be even more severe for the Greek population if they had also gotten consumption corporate taxes based on consumption. So I think we should be alert, and I warn against the system where you base corporate taxes on the level of consumption. Those are a few of the implications for governments. On the next slide, I would like to bring up corporate behavior and investment effects. First of all, I think it's very good that OECD has turned away from a turnover tax like the DST. At least we are not dealing with that anymore. We're talking about profit taxes. I mean, we may have problems with profit taxes and they may be harmful, but they at least do not have the cascading effect of turnover taxes and all the issues with the DST. I think there are also a potential shift of production. If a company has to be taxed where you sell your products, and you typically sell more in big countries, and they tend to have higher corporate tax rates, then of course, if you're going to be taxed there on your profit, even if you produce in another country, why should you continue to produce in the first country when you get taxed in the country of sales later on? Why don't shift production and activity to the same country and allow the deductions to be worth more in the high tax country? I think we will see a movement of production, research and development and costs to high tax countries. And this will be bad for smaller economies and countries with a lot of R&D. I think we can also expect to see a corporate adjustment to the situation by trying to avoid this Pillar 1 and Amount A allocation by not being a consumer-facing business. It's targeted to consumer-facing businesses, and I think we can expect to see some restructuring where companies try to sell to someone else, another company, and that company will then be faced with the Amount A allocated to the consumption country. Of course, there will be an incidence of tax burden shifted around between the companies, and suppliers may have to pay and so on. But I think we can expect a lot of restructuring due to the new Pillar 1 and Amount A allocation. Let me turn, before concluding, to the next slide on tax certainty. Just a few words. Tax certainty is, of course, very important for the investment decisions. And I think the OECD and Inclusive Framework have really done a lot of thinking and work on how to enhance tax certainty. They should have credit for that. But of course, there are a lot of issues that could arise here. I listened to the UN workshop on digital taxation last week and the week before, and I heard that many developing countries would like to see not only residual profits being allocated to country of consumption and market jurisdictions, but all profits should be allocated. How will that be done? I think we have a problem with the concept of consumer-facing businesses. How do we define it? We talked earlier on companies should be taxed where value is created. We all agreed on that, but we never really agreed what it meant. And I think consumer-facing businesses, we run the risk to have a concept we may agree on, but what does it really mean? And that will lead to a lot of tax uncertainty. There is also a tremendous push for using withholding taxes, and we all know how complicated those are and how difficult it is to get them back and credit for them. So I think that's an aspect that is problematic and will lead to tax uncertainty. There is another aspect which I would like to raise very briefly, and it was said in the UN discussion sessions that developing countries could benefit a lot from Pillar 2 and the corporate minimum tax, even if they have a low tax regime, because they could then be allowed to tax transactions undertaken elsewhere, say between Germany and France. If the transaction between Germany and France was low taxed within the group that sell to this developing country, the developing country should be allowed to levy up to the minimum tax on that transaction between Germany and France, even though it's completely outside their jurisdiction. If that becomes reality, I think we are all in for a nightmare. There are issues like effective tax rate, how do you measure it and the like, and I will leave that. Let me conclude by the last slide. I think it's a very important study Matthias has presented, and it raises a lot of these very important issues. The effects on tax competition, and it also highlights you may not agree on scenario 1, 2, or 3, and you don't really have to agree on what will happen in tax rate developments. But all scenarios highlight that if you narrow the tax differential, the tax rate differential between high and low tax jurisdictions, it is the large countries that benefit, and it will infringe on the tax sovereignty of smaller countries. And that's a very strong and very obvious conclusion from the analysis in this report, which I really can recommend. Let me also say that the expected revenue from Pillar 1 and also Pillar 2 is relatively small, but Pillar 1, well, Pillar 2 as well, but in particular Pillar 1 is a new principle in international taxation, and you allocate out your profit to the country where you sell your products and services. And I think we will see more of debate that all profits should be allocated to the consumption country, and it should be, everything should be done that way. And I wonder if amount A is not really a cuckoo bird in the nest that will carve out taxes from the country of innovation and production to bigger consumption countries, to the detriment of smaller countries, because they will be faced with restrictions on the tax policy. Thank you very much.
Yeah, thank you very much, Krista. Thanks for this very appreciative comment with regard to the work that I did. I think you mentioned at least 10 points in your comment that I didn't cover, and a few points that I didn't even think about it. What I find very interesting and also very, very relevant is the fact that companies might actually shift production to locations where they receive the greatest deductions, where certain activities are tax deductible, because of the tax rate adopted in these countries. And that stands pretty much in opposition to what we hear from the OECD, but also many tax activists, actually, with regard to the claim that the proposed reforms would actually improve global capital allocation based on what you just said. And I think this is, it sounds reasonable. We might want to discuss this in a minute. The proposed reforms would add another enormous distortion to global capital allocation, and basically the freedom of companies to invest in locations where they feel production is most efficient and access to consumers is bringing them a good return on their investment. Daniel, now that you've got an insight into my work, but also Christer's thoughts about this overarching and very complex theme, what are your perspectives?
Well, I start with kind of a big picture view of kind of where we've come from, where policies stand at the moment, to inform some of our perspective on what the impacts might be, and what we need to be thinking about when it comes to the impact assessment, what it means for Pillar 2 design. I won't spend as much time on Pillar 1, but let's just start with where are we right now? We have systems around the world where countries have designed their cross-border tax rules so that generally they tax activities, profits from activities within their borders. We call these territorial tax systems, and there are trade-offs with a territorial tax system and protecting your tax base. Protecting your tax base from companies that may want to shift profits out of your jurisdiction specifically for tax purposes. But a territorial tax system is generally designed so that you want activity within your borders to be taxed and allow multinational companies to set up their operations elsewhere and generally ignore that. So, but ignore those foreign earnings for tax purposes. But anti-base erosion policies come into effect, and they claw back some of the benefits of territorial systems, especially with respect to some of the tax planning activities of multinationals. But you see, and this is where you get into questions of what the effects of Pillar 2 might be, economic effects from these base protection kind of policies. And those policies may look like transfer pricing regulations, thin capitalization rules, country by country reporting, controlled foreign corporation rules, patent box nexus rules. And as you look down this list, these are all things that came out of the first BEPS process. The first BEPS process was designed to give countries tools to protect their tax base in the context of a territorial tax system. But these policies don't necessarily come just off the shelf and easy to implement and everything's fine. They have real impacts, and I'll run through some of those. So the impacts of anti-BEPS policies include, like I've said, clawing back some of the benefits of territorial taxation, and Matthias touched a bit on some of these. But looking through some of the academic literature, you can see how the incentives in, for instance, German CFC legislation led to lower investment in fixed foreign assets by German multinationals. You saw thin cap rules. These rules against debt shifting increase the cost of capital and have negative effects on employment and investment. Impact of transfer pricing regulations is similar to just simply increasing your corporate tax rate. And Matthias certainly talked through the impacts of different corporate tax policies on FDI and investment and things like that. And then country by country reporting increases some of the sensitivity of companies to tax rates and where they have their operations. and then eliminating profit shifting opportunities, fully eliminating them, or cracking down on profit shifting opportunities increases the salience of the corporate income tax. And we know from studies on the incidence of that tax that can increase the burden that lower income workers, women, folks marginally attached to the labor force might see from the corporate income tax. So again, this is in the context of territoriality. A lot of countries have been adopting policies in line with the BEPS 1.0 recommendations. And you're getting to a point where most countries, especially in Europe, have these rules on their books. So when you talk about, Pillar 2 and an impact assessment, like Krista was referring to, you have to take these policies into account. And it's not only European countries that have been adopting these policies. In 2017, the US changed its international tax system to adopt a participation exemption, which is an element of a territorial tax system, but also a tax on global intangible low tax income, effectively a minimum tax on foreign income for certain entities in certain circumstances, the base erosion anti-abuse tax, which again is a base protection element, but also an element of attractiveness, the FDII, the foreign derived intangible income regime, to try to make the US a little bit more attractive for locating intangibles for income. Now, in this context where you have all these countries changing these rules in different ways, and you have real impacts of those policies, it's really important to think through what it is, what it means when you have the OECD pointing to an impact assessment that says you're going to raise, roughly $100 billion in revenue, or Pascal Saint-Amand said in a different event this morning, upwards of 50 billion in revenue. I'm not sure what the tangible difference is there. 100 billion is certainly more than 50, but we will see what analysis goes on in addition to this, where you have high income and middle income and low income countries apparently all benefiting from a revenue perspective from these reforms. But as Matthias pointed out, and as I've described, these policies, particularly on the Pillar 2 front, can introduce either new momentum for change in investment or new distortions. And one of the things that I'd like to highlight, I'll stop sharing my screen for a minute, is the opportunity that countries have not necessarily to add a layer of complexity on top of the existing system, where you have multiple countries with multiple different base protection policies, but in fact, a real minimum tax. And let me describe what that means. A minimum tax, in my mind, is not only a minimum rate, but a minimum base. And the minimum base would act to minimize the effect of the minimum tax on investment location decisions. So if a company is deciding in the context of a minimum tax, whether to continue investing in the country that they're in or to choose a different location, that the minimum tax should not play a role in distorting that investment or decision one way or the other. Now, how can this happen? Well, one of the leaked drafts, I believe it came out in August, described an option for designing the minimum tax base with what we at the Tax Foundation like to call full expensing. Basically saying that with respect to designing the minimum tax and measuring the effective tax rate, companies would be able to adjust their global financial statements, their global taxable profits based off of that by deducting immediately all capital costs. So if a company is investing in a new factory, the cost of investing in that new factory could be deducted in the first year. Now, there are a couple of benefits to taking that approach. One is it eliminates the challenge of aligning a minimum tax base with respect to all the different country systems that have different rules for deducting those capital investment costs, and basically takes the lowest common denominator. A lot of countries, including the US, have full expensing for certain classes of investment. Estonia, as Matthias was pointing out, basically has a system where everything can be fully expensed. They have a cash flow tax. By taking this lowest common denominator approach, the Pillar 2 minimum tax could be more neutral toward different investment decisions. Now, a second benefit, one of the things that Matthias points to, is the potential for the minimum tax to be essentially a gravity well, where countries basically set their policy toward that minimum, and you have this, you end up with this narrowing or full narrowing, where maybe countries that currently don't have a corporate tax system might adopt a corporate tax, and they target their policy toward the minimum, or countries that have tax policies above the minimum tax would target the minimum tax for their approach. If you have a minimum tax that's designed off of a full expensing approach, then what you have is countries potentially learning the right lessons about designing a corporate tax base and aligning themselves from a corporate tax perspective. One that, again, as Matthias pointed out, may have implications for smaller open economies, but it is less distortive from the decision-making point. So if a company wants to expand in the countries where they're currently expanding, that the minimum tax is basically neutral in that decision. Now, the minimum tax would still charge tax on profits, but profits after all of those capital costs, all of those investment costs have been taken account for. Economists like to say that the cash flow tax falls on excess profits by design, that once the required rate of return is reached, that profits above that required rate of return are what are taxed under that sort of approach. Now, certainly, this is just an option in Pillar 2, and that's why I'm highlighting it. I have no insight into what countries are really interested in discussing. But in the context of this discussion and your study, Matthias, I think it's worth pointing out that there are design options still available to make this as neutral an approach as possible. Now, on Pillar 1, I'll say just one thing about that. The neutrality principle is go ahead. Yes.
Sorry for interrupting you. Yes. I just have to ask you to come to an end because we are a bit running out of time.
Yes. One thing on Pillar 1, I'll just say the principle of neutrality is non-existent in Pillar 1. It is carving out a particular sector and identifying a new principle that is in contrast to another principle in tax policy. So while there's an opportunity for neutrality in Pillar 2, I see much less of a path towards a tax design that is neutral in Pillar 1. And back to you, Matthias.
Yeah, thanks, Daniel. I mean that was great. As you just saw and you heard, Daniel is also another person to go to if you are interested in the broader perspective on corporate taxation and the developments that we see at international level, but also the technical details. And I would agree with you that neutrality, the principle of neutrality, is certainly lacking. But what's also lacking is the principle of simplicity and administrability. And this is not only true for Pillar 1, and I think it's also true for Pillar 2. But finally, Sigurd, now that you've heard 3 comments, basically, what are your perspectives on the impact of the OECD's corporate tax reforms?
Yeah, I'll try to really stick to 10 minutes. I've just, and also listening to the debate, I think I'm probably not going to say anything new, but maybe in a slightly different way. And first of all, I must say I was very much inspired by your piece of work, because I think it highlights the fundamental issue that what is actually the impact of the OECD proposals from a economic perspective, and also maybe a focus on specific countries. But I have just 5 questions I want to raise. So if you can just scroll to the next slide. So I have 5 questions I'm raising here. So what is the purpose of the entire exercise? What is the proportionality in this proposal? What is the additionality in the proposal? And I think the second and the first and second is about the revenue effects. And then the fourth or fifth question is about the real economy aspect. So let's just discuss about what is the purpose. So if you can scroll down, yeah. So I think fundamentally, I think what is needed going forward is to make a clear distinction between two different aspects of policy reforms. The first one is the profit shifting. Profit shifting is essentially money flowing between two countries, and in the first case, it has no real economy impact. But of course, countries want to get their fair share of the tax base. So, to what extent are the proposals effective in addressing profit shifting? The second one, which I think is at least as important, is what is the effect with respect to resource allocation? And I think the starting point for this is what has been driving corporate tax reforms in all OECD countries since the 80s, namely the observation that corporate tax systems were hugely influenced by what I call a debt bias. So high corporate tax rates in conjunction with a number of different exemptions and so on and so forth were really punishing high risk, high reward activities compared to low risk, low reward activities. So I think the debate now has kind of shifted around and saying the only reason why we cut corporate tax rate historically was as a kind of tax competition. But I think that is not really how history has been. It has mainly been in a number of countries about the statutory tax rates being cut to allow a more effective tax system. And I think it's also reflected in the basic facts that effective tax rate has not been lowered that much over the last 10 years, hardly at all. And the overall tax revenues from corporate taxes remain broadly stable around 3% of GDP. So I think we need a proper initial discussion of what are the purposes and what is the weight attached between fighting profit shifting as opposed to improving the functioning of the real economy and taking as a premise that we still in the global corporate tax system have a huge debt bias, which is harming the economy. Then I would like to go into the proportionality discussion, which is about the tax base. So looking back at the early work done by the OECD in the early zeros, there was a identification of a possible profit shifting that led to losses of CIT in a range of 4 to 10%. Now, that was, of course, based on really pre-BEPS, how the national tax system looks 15, 20 years ago. When you look at the impact assessment now put forward and already discussed in previous presentation, they suggest that the CIT revenues could go up by 4%, which is basically closing the tax gap of earlier OECD analysis. Most of that come from Pillar 2, and unless we have a cuckoo nest effect, as Krista suggested, very, very little from Pillar 1. I think we need to put that into a perspective in the sense that corporate tax revenues is 3% of GDP. So we're talking about maybe an increase of 4%. So compared to all the other big holes we have in the fiscal tax systems, tax gaps in VAT and so forth, seen from a purely ability to increase public revenues, this is not a very much, these are not large amount of money. But then comes, I think, the real interesting issue, the additionality. And the next one. So, as has been said many times before in this presentation, the estimates are based on 2016 numbers. That was well before the BEPS process and so on and so forth. And as you also saw from the presentation from Daniel, it appears that all economies are winning. And how can that be? That is because in the OECD calculations, all the new revenues are coming from what one could call tax havens. So the question is, it begs the question is, has the BEPS process not been able to deal with tax havens? So is it really true that we have an untapped potential to take money out of the tax havens? And also, one should remember that these tax havens are not final depositories of money. Once they are repatriated back to the original source countries, these money will be taxed. So I'll give you here an example from a Nordic context. I think that at least one Nordic country that I know of who will suggest that the BEPS process, in particular the very tough CFC rules they put in place, have actually allowed them to recuperate a lot of money that would be 5 years ago not flowing to this country. And from their perspective, the net result on Pillar 1 and Pillar 2 would be a net tax loss. Because what is happening is that not only is the increased focus on shifting money out to market economy something they will lose from, but they will also lose the gains that have from the BEPS process, because all this money has been flowing back from some of the tax havens and going to the Nordic country will now be shifted out to the market economies. And so this reconsideration of additionality, what is really bringing on top, is not a academic perspective. That is something specific member states are right now looking at. What will it bring on top once you consider all these other proposals? Now, then I like to move to the distortion perspective. And I also been reading over the weekend both the leaked draft proposals from Pillar 1 and Pillar 2. So let me just bring in a bit of discussion around this. If you look both at the Pillar 1 and Pillar 2 proposals, there is a recognition that there are problems. So, for example, just one problem. It's recognized in the context of Amount A that we need to have some proposals in place that allows carry forward, carry back of losses. So essentially to say, yes, we have a number of business models that will eventually, as Christa said, bring in what looks on paper like super profits, but that's just a consequence of these companies, these countries having a lot of losses early on in the life of that particular company. So we need, in fact, now to introduce some rules that allows these losses to be considered when we calculating the Amount A. There is also a discussion in this paper of whether these carry forward of losses should not only be carrying forward of losses, but also profits below the threshold of return. And the OECD is recommended against it. But it just shows that the Amount A is introducing a number of new distortions into the system that then needs to be, amended by a number of very complicated new rules. In Pillar 2, the same applies. We have a number of rules in the national tax systems, patent boxes, and so on and so forth, that has the specific purpose of encouraging investments in activities that has large spillover effects. So the OECD is discussing very complicated new rules to find out to which the minimum effective tax rate need to be adjusted for specific factors that are in fact growth enhancing. Again, if you look through these discussions, very, very complicated new instruments to need in place, and I think very difficult. So there is already clearly a discussion in the OECD. There's a recognition that we may indeed introduce new distortions to the system, and they are very difficult to control. I would also add that the introduction of formula apportionment, which is a consequence of certainly Amount A and maybe also some of the other.
Sigurd, I think you muted yourself.
Voilà. So the formula apportionment is well recognized in international tax law in tax economics to introduce new incentives to profit shifting. So, for example, I'm a company and I have a choice to, and that is what Chris is our business model. I have an incentive to employ people in low-cost countries, in countries that has low tax rates. So rather than running a franchise model, I actually have a model where I actually employ people in different countries. So that is called the employment game. So I think there's a lack of recognition that some of these new instruments like formula apportionment is in fact encouraging new distortions. And the problem is that these are not only moving tax base around, they're doing something that is much worse they're changing really economic activities. So you set up business models not to optimize the functioning of the firm and enhancing productivity. You're actually suggesting that I may be better off having a less productive company because I can actually shave some money off my corporate tax bill. So that is some of the issues here about that the proposals may in fact reduce economic efficiency. And that leads me to the final point about the stability of the global tax system. Because I think the main problem we have with both Pillar 1 and Pillar 2 is that they are highly complex. And they are, as you will see from the description of the draft proposal, very honest draft proposals of the OECD have done, include a discussion of a number of choices that need to be made that are almost by its nature very arbitrary, because the definition of parameters, the definition of scope, for example, what is in scope for amount A, will define not by real economic principles or basic tax principles, but by arbitrary scope discussions. And that will be an invite for me to instability of the system, because if you have a tax system that is built on parameters and in scope, out scope, that doesn't have a foundation in sound economics, they will be inevitably something that everyone will try to game with and be a part of dispute. And I'll just give you here one example. So in Pillar 1, there is a discussion of what should be in scope. Should it only be digital business model, or should be also consumer-facing industries? That is in itself something that is still discussed. Then there's discussion on what industry should be in scope. Then they discussed the pharma business. And of course, here we come into what is consumer-facing. So we go into a discussion on what kind of activities within the pharma industry should be included. So they discuss, okay, should we only include profits that are linked to prescription models, or should it be limited to over-the-counter sales? Why is that discussion relevant? Well, because if it's over-the-counter, it's clearly individual consumers who are buying it, while it's prescription drugs or drugs that are prescribed in hospitals by doctors, then they're not consumer-facing. Okay, so this consumer-facing becomes then a determiner of whether a particular company should pay taxes in any given country. But I cannot see any meaningful tax principle that is rooted in tax economics that would determine whether, let's say, a big pharma company would pay taxes in, let's say, Spain, based on whether the Spanish medical system had decided to have a low or high level of prescription drugs or specific. So it just suggests that when you go into the specifics of how to design these highly complex systems, you are increasingly leaving principles of economics and also what was the kind of the original argumentation for including pharma, which could be, well, the pharma industry is doing a lot of clinical trials in specific countries. Clinical trials could be said to be something that had user contribution. But then when you move into the actual discussion of it, you're completely leaving aside the underlying reason why or why not the pharma industry should be included in scope A. So my basic argumentation here is that I think somewhat because we have lost the sight of what is the purpose of this, what is the proportion, what is the additionality of this, how much can actually bring into revenue as a one part, which on the current principle will be extremely limited when you take into additionality, then what are then the costs of it, namely new distortions to the global tax system and the complexity. Then I think the assessment coming out of Martin Brauer is we need the balanced overall assessment is how additional that is into covering well-identified tax holes in the global tax system that has to do with dealing with tax havens and profit shifting, as opposed to what will the new tax proposals by the OECD in any configuration do to dealing with real economy tax distortions, and what we'll do to create or not to create a stable tax system. I think we need this overall evaluation still, and I hope very much that the OECD work going forward and private research projects such as those entertained by ECP can bring more shed more light on this. So where we out of this comes a better functioning global corporate tax system that is stable, that closes well-identified tax holes, and improves the global functioning of the real economy, notably by addressing debt bias and so on and so forth. So
Okay.
Thank you very much.
Yeah, thank you, Sigurd. That was another very rich and very thoughtful assessment of what we saw and what we might see on the side of the OECD and governments supporting this work. You mentioned new tax distortions, new ideas which would create new distortions, and you may also mentioned the stability of the global tax system. Well, my impression is that the more ideas emerge, the more complex it gets, and the farther away we get from a consensus. I can see a hydra from every idea emerging on the side of the OECD and others, creating more problems than it solves, actually. But let's turn to a few questions that were raised by the audience, and I would like to address these questions by you, starting with Christer, then Daniel, then you, Sigurd. There's one question which was asked by Jerome Lammers. He says, I've recently argued that in the case of full narrowing of tax rate differentials, countries will turn to other policy instruments to compete for FDI, such as wage tax arrangements or R&D subsidies. These arrangements could be more harmful than the current tax competition that we see in the corporate income tax regime. How do you view this? Christer.
Thank you. I think Jerome has a point. I mean, they would use other instruments, and of course, some of those instruments could be equally harmful or more disturbing to bigger countries, because we see a big battle here between big and small and export countries and consumption countries, and there could be bigger problems. I noticed there was also a question about what's really happening, and maybe Daniel could say something about what Pascal Saint-Amand said at 2 o'clock today in an interview. I would also like to just mention that the UN had a 6-day workshop on digitalization and taxes. I thought it was a very good event, and developing countries got the opportunity and experts to express their concerns. I think that is something that would be very beneficial at the European level and the OECD level as well, to organize something what Michael Leonard did at the UN. That was an excellent situation and event. It also highlighted that many developing countries are, of course, concerned that they may lose the right to have tax incentives, because then they will be hit by a Pillar 2. So I think that's important to address. Thank you.
So I'll agree with Christer that if you move away from tax-based incentives to spending-based incentives, you might have some countries certainly move in more distortive kind of ways. There's a reason that the EU has general restrictions against state aid, but the EU doesn't. EU state aid restrictions doesn't govern the world. Certainly, there are some, kind of WTO restrictions on different subsidies. But yes, if you move away from tax-based competition, other things will crop up. Countries will still compete. They will compete on other bases, on other margins.
Sigurd, do you have something to add on this question as well?
Yeah, I think it goes back to my remark about that we have still in the global economy a debt bias. So basically, why do we have the corporate taxes in the first place? So it's not a prerequisite for taxing returns from capital income. You can do that at the individual level. So I think the basic problem, the way investment is organized at the global level is you very often have large portfolio investors as investors. That means the corporate tax then becomes the final tax on income, and it cannot be relieved by the individual shareholder level. So then that brings to the question is, what is then the biggest problem we have? Is that the corporate debt bias, or is it the problem that the corporate tax rates are different in different countries and then move either the profits around or real activities around? So I think what of these two are the biggest problems? And then coming back to Jerome's comment, now what is then the consequence if you can no longer attract businesses through a generally low corporate tax rate, which is in general non-distortive, is in fact welfare improving? Can you then start moving more distortionary attractions? And I think here also the Pillar 2 text from the OECD is interesting, because it does suggest that certain kind of preferential tax regimes can be taken into account when you calculate the minimum tax rate. The question is just, is that such a fantastic good idea to start polluting the corporate tax system with specific incentives that can be taken to a place? Do we want that? Also, to what extent will we see if we are not controlling, as you said, state aid? So in the US, we know that corporate tax holidays and all kinds of different regimes are being very much used to attack FDI. Do we then need to bring that into the international field? And that is that feasible, and so on and so forth? So are we opening a can of worms by limiting the ability to attract businesses by having a low general corporate tax rate and then moving to other fares? Good question. And the question is, again, something to be analyzed and understood in terms of how does the OECD proposals affect incentives for governments to do something differently, and is that a good idea?
Okay, thanks for your perspectives. Let's discuss two more questions. There's one question from Vladimir Stipek. He's referring to the current dispute between the US and the OECD about the long-term solution for the digitax or a similar tax regime. He's also mentioning, as we know, that the US left the negotiation table. And it's probably still difficult to find a consensus for the future. I mean, what are your perspectives on that front? And then there's one more question from Sol Picciotto. Christer accepted that it would be very desirable to find an alternative to digital services taxes, while Daniel saw ways to improve the GloBE minimum tax proposal. And the question is actually addressed to me and Sigurd. Do we actually consider the GloBE could be improved? GloBE could be improved, so it would be a better option to digital services taxes. And I will start with the latter question before I pass on to you. As concerns GloBE minimum tax proposal, I tend to oppose it quite vehemently, because I feel I'm a principled guy when it comes to taxation. No taxation without representation, and a multilateral organization and other governments, primarily large governments, should not determine how tax policies should take place in should be shaped in a sovereign country. If you think of Ireland, for example, there's not much of a debate in Ireland about the harmful implications of Ireland's corporate tax regime. So the terms abusive practices, aggressive tax planning, they don't spur a lot of public debate in Ireland compared to other jurisdictions, obviously. So that would be my brief answer to that one. Sigurd, what do you think about GloBE and DSTs? And Daniel and Christer, may I ask you to elaborate a bit on what's the outlook regarding the US coming back to the table, and what would be the impact on the proceedings and the outcomes eventually?
Let me, and here it's relatively easy for me to say, because here we are on record as having produced a paper on it. I think I would, in terms, I mean, there are two issues here. There's a political issue, which is that everyone needs to claim victory. That's a basic concept in political economy. And I think I will roll back a bit and say, what was the main justification for the DST when it was proposed? Was that some companies were not paying on a global level enough in taxes, a tax level that would exceed any meaningful rate of effective tax rate, or was it primarily discussion about user contribution principles? So whatever these tech giants were paying in the United States, whether it was 30% or 40% or 50%, in any case, the countries in which they were operating, but where they had no direct revenue, there needed to be some kind of allocation of revenues. I think for me, that is one important part of the political discussion. What is the primary driver of the argumentation for the DST in the first place? Is that the user contribution principle, or is it making sure that the companies involved in that was paying sufficient amount in taxes? If the latter isn't the case, then I think GLOBE, combined with the US tax reform for 2017, that has ensured minimum level taxation in the US from US companies' global activities, might be a way of solving this. That's my perspective on it. Thank you.
Matthias, do you want me to take the next question?
Yeah, please go ahead. Thanks.
Sure. So just a point of fact, the US did not pull out of the OECD negotiations. There was discussion in June as to whether some countries perceived them as pulling out simply because the US was not willing to agree to those countries' terms, which is very different than the US pulling out. The discussion continues, and as what was reported on in June and I think early July, is that the US wanted to communicate to its negotiating partners that the election may matter for implementation of whatever is agreed. So it is important for other countries to take that into account. Certainly with respect to the DSTs, there is bipartisan opposition within the US. And there have been tariffs threatened, and I hope that there is a resolution to that dispute that comes without high tax and trade barriers in the context of this other multilateral negotiation. But the U.S. is still involved at the OECD, still advocating its positions both on Pillar 1 and Pillar 2. As Pascal Saint-Amand described this morning, on Pillar 1, the U.S. is interested in an approach that would allow companies to operate within Pillar 1 on a safe harbor basis, and the potential attractiveness of Pillar 1 could come from tax certainty, although I am highly doubtful that will actually be attractive given the design of Pillar 1. On Pillar 2, the U.S. Is very interested in having the GILTI regime approved as an appropriate minimum tax and not have to change U.S. domestic law with respect to the globe. So that's kind of the update there. And we will certainly see what happens with the election and whether there needs to be a kind of a reset on the new U.S. negotiators' standpoint, even if there's not a reset on the specific negotiating points.
Christian, would you like to add?
Yes, just a remark. I think the train has left the station, and I think, of course, we must try to find an international agreement on how to allocate taxes among countries. And it would be a big surprise if the outcome we just had a few years ago was exactly correct for distributing tax bases among source and residence countries. I don't think so. And I think the amount B is probably at least as important for source countries or developing countries as amount A. I think we should work a lot more on that. We should also analyze the implications for tax competition and in particular smaller countries without any natural resources and nothing really to compete with. Should we disallow them from using taxes if they do it openly and in a transparent way and exchanging information? Probably not. I am very hesitant to limit sovereign states in their ability. But we could certainly discuss how do you allocate the tax cake between countries, and it's a reasonable request from many countries, even though some of those more vocal countries, think of France and others, claiming that they should have such a big cake of the digital tax. They do have a lot of tax concessions domestically to their own sector. And maybe they should look into that first before asking what others should do. I also think we should give countries have the right to tax consumption, and they should be able to collect tax revenues on digital services as well as other services and goods. And I think we need to develop that much further to raise revenue in that way. Thank you.
Yeah, thanks, Daniel, and thanks, Christopher, for these two final assessments. I think we need to come to a close here. We've had a very rich debate, a very pro debate. I very much hope that the potential impacts that we addressed in detail, even though we are also all uncertain about the size, impact, and to some extent also the direction of these impacts will be, that these potential impacts will be taken into consideration when new impact assessments are prepared, also on the basis of the updated proposals that will arrive from the OECD soon. I would very much appreciate a much more honest debate about the real impacts on investment, on, as you mentioned, Christer, the size of the pieces of the cake that is going to be distributed or allocated or reallocated between jurisdictions. That said, I would like to thank you. I would like to thank the panelists for your excellent contribution, for your deep knowledge that you injected in today's debate. And I would also like to thank our audience for staying with us for almost 2 hours to discuss a very exciting topic, which is corporate income taxation. Yeah, so let me close this session. I hope we see each other again soon to discuss the further proceedings. And that's it. I wish you a good day and all the best for the next time in a situation that is not too easy for people pretty much everywhere. Okay, let us close. Thanks a lot.